let's talk about dividend investing, which is something that's really appealing and exciting for a lot of investors because, hey, who doesn't like passive income, getting money paid to you every month, quarterly or annually? And I think that's an amazing thing. And I actually invested a lot in dividend stocks myself. And that's why in this video, I want to talk to you about, in basic terms, what dividends are, why companies are paying dividends, and answer the question whether it's better for you to invest into dividend paying companies or non-dividend paying companies, and share with you my personal strategy of what I'm planning to do with my money going forward. Now, a quick look into my portfolio, which I track over here on GetQuinn, which is amazing. I can link up all my various brokers and it pulls in all the various data sources. And you can see my total dividends paid so far to me, $1,500. And I didn't actually start so long ago. You can see over here, back in 2020, I didn't get any dividends. Then I started very slowly with $15 over here. In 2020, I started taking it more serious, $162. And then from 2023, last year, I went to $577. And this year in total, I will earn even more than twice the amount I earned last year with $1.3 thousand. And moreover, let's look into one of the greatest investors of all time, Mr. Warren Buffett over here. He has various investments, and one of his biggest over time actually turned out to be Coca-Cola. And you can see right now he's getting in a year $704 million in dividends. That's not taking price appreciation into consideration, purely dividends, which is hourly $87,000 just in the form of dividends, right? So really amazing. It just shows you dividends can definitely be a very powerful investment vehicle. When I myself was a Coca-Cola shareholder, I was walking into any Costa store, which is Costa Coffee, which was bought by Coca-Cola a while ago. And I felt like an owner, right? When I went in there and ordered my coffee, I mean, it's a really cool feeling knowing that obviously you pay for the coffee, but in return, the company pays you a dividend for being a shareholder. It's a really cool feeling, and one of the reasons why a lot of people invest into companies, because they feel like a shareholder, like an owner, which they technically are, right? You might have a very little share, but still you are. Plus a lot of other benefits, and I'll come to this. And I also come back to those two bananas, which are actually really powerful when we talk about dividends versus total returns, but we'll come to this in a second. Right, so let's talk about what dividends are. And I want to really keep it very simple. Obviously, you can make a PhD out of it, but I always like simplicity and keep things really easily understandable. So essentially, majority of companies in the world are for-profit companies, right? As the name implies, they aim to make a profit. And the profit is a result of the revenue they achieve, which basically is all their sales from products, services, whatever they sell. It's all the revenue that comes in at the top line. Then they have all the various expenses, like the payroll, the salaries, the cost of goods sold, the rent. All those things together are the total cost of operation, basically. And in the end, they end up with a profit, hopefully, right? Some companies generate a loss, but most companies that are successful in the long term generate a profit. Now, with that profit, there are three options that they have, basically. The first one is they can reinvest those profits, or at least some parts of the profits, into research and development to further grow their top line revenue, right? The more money they reinvest, they can come up with new ideas, new innovation, and then once again in the future benefit from it. The second option is they could buy back some shares, right? Because the company itself does own some of the shares or some of the shareholders, but they could use some of those profits to buy even more shares and increase their ownership of their shares in their own company, so to say, or the stakeholders of the companies could do that, which is very popular. Many companies, even Apple has done that in recent times. And the third option is to pay out parts of the profits, if not all, but usually it's part of the profits in the form of dividends to shareholders in the company. So anyone who has a share, even if you own one share in the company, you will get a proportionate return of the profits paid to you. And that's obviously what a dividend is, sharing some of the profits to the shareholders, and you receive that as a shareholder. So you benefit basically, the more profitable a company is, you will benefit from that in the form of monetary compensation. And those dividends can be paid either on a monthly, quarterly, or annual basis, depends on different countries and different companies, but usually, most commonly, it's either quarterly or annually. In Europe, it's usually annually. In the US, it's usually quarterly, but as I said, some companies also choose to pay on a monthly basis. Now, next question is, why do companies actually pay dividend, right? And there are a lot of reasons for that. The first and most obvious one is to reward the shareholders. You, as a shareholder, in case you buy a dividend company, obviously want to get a return, and the company wants to incentivize you for buying their stock, right? When you invest into a stock and they pay you dividend, that's rewarding the shareholder. So that's a very popular point. And by doing that, they will attract investors who are looking for a passive income stream, right? Because different investors have different investment preferences. Some people like gold, some people like real estate, some people like to get that passive income paid to them. And that's obviously very attractive when you invest in dividend companies, right? Because some of those companies, they can pay a 10% dividend, which is amazing, right? Imagine you put 100,000 euros into a particular stock, they will pay you 10,000 euros per year in dividends. So it can be very attractive. Of course, it also shows usually financial health, because a company would not pay a dividend if it wasn't in a strong financial position. And a lot of companies have actually cut the dividends over the years, which dividend investors obviously don't like, because they invest in the company to see the dividend being paid out regularly and ideally increase over time as the percentage increases. But some companies that had bad performances over certain years actually decided to cut the dividend and instead use the money to grow their business, which often seems to be a smart decision for the business itself. But of course, an investor, you still want to get the dividend because you factored that in your own calculations of reaching financial freedom or whatever your goal is in investing. It also usually shows a maturity in the industry. Very dynamic companies and industries like AI sector and tech sector, they usually don't pay a dividend. Now, some of those companies that we know, like Nvidia and Meta, recently started paying dividends, even though it's very, very small. So I actually wouldn't call them a dividend paying company. Technically they do pay, but it's very, very small because they reinvest most of the money into research and development. While some other companies like Coca-Cola, Starbucks, the industry is already very much matured, right? There's not so much innovation going on, so they can actually afford to pay out more of their profits in the form of dividends to the shareholders. Now with this, we come to the question, what is actually better? Investing into dividend paying companies, or better to invest in the non-paying dividend companies that potentially have higher growth and have a higher share price appreciation in the long term. Now let's start off with dividend paying companies. And here, for example, we have Coca-Cola, one of the few dividend kings in the world, which means it has paid and grown the dividend for at least 50 years or more. In the case of Coca-Cola, actually for 61 years. So they haven't really cut their dividend for so long and actually grew it ever since. And yeah, really impressive. Despite the dividend being not that huge, 2.89%, it's still considered a very strong dividend company. And when we talk about dividend companies, personally, I define it as any company that pays more than 2% in dividends. As I said, even companies like Nvidia started paying dividends. But you know, when we look at the dividend yield, I mean, it's 0.04%, which for me is literally nothing, right? It's negligible. So you would have to have a lot of Nvidia shares for that to make some kind of difference in your portfolio returns, because you wouldn't really notice that. So in that case, I would not consider Nvidia a real dividend paying company at this stage. Maybe they will increase it in the future, but for now, I would not consider. And of course, the big appeal of investing into dividend company is to receive the dividend, right? And you see here in the example of Coca-Cola, over the last 10 years, every quarter you would have received a dividend. And not so long ago, 10 years ago, it was only 31 cents. But as I've shown you before, they actually continue to increase, not just pay, but increase. So now it would already be 49 cents. So you see, the dividend itself increases. So that's really attractive and why people invest in it for the long term, to start benefiting from the compound dividend growth, which is obviously very impressive, as we've seen in examples of Warren Buffett early on. Now, if it's that great to get a passive income, the question is, why isn't everybody investing into dividend paying companies? Well, that's a good question. And one of the easiest answer is when we compare the total returns versus, for example, the market, which I would consider the S&P 500 as the golden benchmark. So when we now compare Coca-Cola to the S&P 500, you see over the last 10 years, the S&P returned 241%, while Coca-Cola only returned 134%. So it's a major difference. Despite getting a nice dividend, which is nice to see and receive over time, actually total returns have not done that great. And that often seems to be the case with a lot of the dividend companies, especially the popular ones, are underperforming, especially when we compare them to tech companies and many other thriving sectors out there. Right, and on the flip side, of course, we have the non-paying dividend companies. And one of the 10 biggest companies in the US and as such in the world is, of course, Amazon, right? Everybody knows about it. And they pay absolutely zero dividend at this stage. Maybe they will decide jump on the bandwagon as well. But for now, as you can see over here, Amazon is not paying a dividend. So if you would invest into Amazon, you certainly wouldn't do it for the dividend. So the question is, why do you invest into Amazon then if you don't get a passive income? And that's because you invest into price appreciation of the share price. When you bought it, for example, at a lower price a few years ago, and you wait for the price to appreciate over time. Now, obviously here, you don't get a passive income, which may not be so exciting. However, the benefit of investing into high growth companies that don't pay a dividend, because as we discussed before, most likely Amazon reinvests more of their profits into research and development, into new company initiatives to keep them at the cutting edge and keep on growing. And that's being reflected in their share price appreciation. And we can see that when we look at the total returns, once again, versus the S&P 500, we still have the same 241% for the S&P, but Amazon in the same period of 10 years grew by over 1000%, right? So you see a major difference, and that doesn't consider any dividends because they didn't pay a dividend. Here, the dividends really wasn't a deciding factor. It was more the total returns in the form of price appreciation. But of course, it also often means that those stocks are more volatile. You see over here how the price for Amazon has dropped quite significantly for a while. So if, for example, in this stage you needed the money and had to sell the shares, you would materialize maybe potentially even a loss, right? While the S&P really steadily grew over time, and a lot of the dividend paying companies, maybe they didn't grow that fast, but they would still pay you that sweet cash flow consistently. So again, we'll come back to this in a moment when I talk about my personal recommendations, but that's something to consider. There's usually a higher volatility with those high growth stocks. All right, I promised you I'll come back to the example of the banana. So here we have two bananas. One is slightly bigger than the other, but more or less, essentially, they are pretty much the same. So let's assume the bigger one resembles a high-tech growth company, like for example Amazon, and the slightly smaller one would be Coca-Cola. We've seen the returns before, so definitely lower returns than Amazon had. So maybe it would be even like that, but let's imagine the bananas are slightly different in size. Now let's take Coca-Cola in this example, and if that banana resembles the total return that you got with Coca-Cola in 1 year, basically that's all the returns, 134% return that you would get over a 10-year period. However, when I go up over here, I can see the pure price appreciation without dividends was only 70%, right? So out of 134% total return, only 70%, around half was from the price appreciation, which means the other half came in the form of dividends. Or to visualize it, let's take half the banana and a little bit less over here, and boom. And here we basically have Coca-Cola 10-year performance. That is purely price appreciation, and that part is the dividend. So basically, you as an investor would get a whole banana, the total return, right? But it's just basically sliced and diced in different ways. One way is paid to you on a quarterly basis to keep you from starving in the form of dividends, and then the rest comes step by step over time in the form of capital appreciation or price appreciation of the share price of Coca-Cola. So those two components together make up your total return. And I think that's very important to really visualize that, because some people are really so obsessed with the dividend component, but they often forget that those two parts come together, and those two together is what we should be looking at, and especially comparing it to other investment vehicles, because we don't just look at dividend but total returns. Because in case that banana only gives you the dividends, but that part, capital appreciation, is actually performing poorly, and you may not even get it because it remains flat or even goes down in price, which can also happen, you're now only left with half a banana or even less if it's a smaller dividend. And if I compare that to a company that returns a full banana or even bigger banana, you really see a difference in performance. Now, I hope it makes sense. It's a little bit different way of explaining it, but I hope it resonated with you. It just shows you we need to look at total returns. And that brings me to the last part of what I'm planning to do with dividends. Now, I used to have, obviously, as I've shown you before, quite a bit of dividend shares, but in the meantime, I already sold a lot of those dividend shares because I really did a critical look and I compared the two bananas in a way, to continue that example. And in many cases, I realized that my dividend banana in that way was actually much smaller than the non-dividend banana, meaning that most of my dividend shares underperformed the S&P 500 or those companies that did not pay a dividend. And ultimately, me as an investor, while it's nice to get some passive income, if I add it all up, ultimately I'm worse off than if I kept it in investment without dividends. Then I'm doing myself a disservice by not maximizing my capital, my hard-earned money, right? I want to make sure it grows the fastest, most reliable way long-term, rather than feeling a little bit good about myself. Like I showed you the numbers at the beginning, it's great to see that, but long-term, I'm really not maximizing my funds. So I always look at total returns. So this is, for example, a company I used to invest in, Altria, smoking company. They paid a very juicy dividend. Here you can see 7.7%. It used to be close to 10% even, so really attractive, right? But however, once again, if I compare it to the S&P 500, you see over here that actually the total performance over 10 years is absolutely underperforming the market. 241% for the S&P versus only 132% for Altria, so really underperforming. And even bigger difference comes when I look at the price return, so the share appreciation and share price over time. It's only been 24% for Altria, so really, really very little. The rest came in the form of dividends. So it's nice to get the dividends, but once again, in terms of total returns, it's still underperformed massively. And you always have to ask yourself, why does such a company pay such a high dividend in the first place, right? And often the answer is because otherwise investors may not even invest into it. Let's be honest, smoking probably doesn't have a very bright future outlook, right? So they have to pay an extra high dividend to attract and keep investors. Another concern that I had as a dividend investor previously is the withholding tax. Now, a lot of US-based, pretty much all US-based companies that pay dividend, if you are not living in the US, you will either pay a 30% dividend withholding tax. So if you receive $100 or euros in dividends from the US, technically you would only get $70 because the rest is kept by the US as a US dividend withholding tax. Now, some countries do have a tax agreement with the US, so you can reduce it. In my case, previously it used to be 15%. So it depends on where you live, but still, that's another tax that you will pay on top of the tax you will pay on the income that you receive in the form of dividend, plus of course on the capital appreciation if you sell your share in the future. So you will be hit with 3 taxes. So it's not the most tax advantaged method of investing also. And that's why I started consolidating all my individual shares into the S&P 500. That's the ETF I'm buying, which is the State Street SPDR, or SPY5 is the ticker symbol. It is the cheapest S&P 500 ETF out there. It only has a 0.03% expense ratio, so really attractive. And technically, I'm still getting a small dividend. It's only 1.12%, so that's why I'm not considering it dividend investing. But still, even with that, as you can see, for next year, I will still be earning $562 in the form of dividends from my S&P 500 holding. So that's a nice benefit, but I'm not banking on it. I really look at the total return, and that's really difficult to beat the S&P 500 in terms of total return performance. But of course, if you manage to outperform the S&P 500 with your dividend shareholdings, then all credit to you. And of course, it doesn't always have to mean that you need to necessarily outperform the S&P 500. You might also be happy with a little bit lesser performance, but still get a passive income, which eventually might pay for your living expenses, right? And that way, a good thing and benefit of dividend investing is that you don't have to actually ever sell your shares. For me, in my case, if I don't have any dividends, eventually I would have to sell, regularly some of my shares to liquidate those and then use the proceeds to pay for my living expenses or buy an apartment with it or whatever. You, on the other hand, if you invest in the dividends, if your dividends grow over time, you might actually reach to 6-figure dividend annual income, right? Which is amazing. And then you can pay your living expenses purely from the dividend. So I think that's really attractive. And as I said, also you have less seasonality because they're less volatile, those companies, right? So even if some of the other high growth stocks go in a bad period, in a bear market, some of the usually traditional dividend paying companies, they're more robust. They're less likely to go up in price, but also less likely to go down. Because if somebody invests in purely growth stocks, and let's say they go down for 1, 2, 3 years, which we have seen in the past, and then they need some kind of money, they would have to sell those companies at a lower price, potentially than they bought it for, and materialize the loss just to get the money and then pay for whatever they have to. So in this case, dividend investing might be more attractive for you. So you see, there is really no right or wrong. It's a personal preference. I really understand people that invest in dividends, and I think it's great. I mean, I love getting those dividend payments to me as well. But my recommendation to you, be honest to yourself. Don't get just blinded by the dividend component. Look at the total component with the price appreciation together and see if that total return your company investment gives you is good for you. Then that's great. You don't have to listen to other people. That matters, but don't just look only at the dividend parts. Just because they pay a high dividend does not mean that the total company is giving you solid returns. I hope you found this video useful. Next up, check out this video over here. As always, thanks a lot for watching. Stay healthy, get wealthy, and to see you in the next one. Ciao.